I'm joining you today from the AllianzGI core fixed income team to discuss the latest thoughts on strategy and markets and how this has been reflected in our unconstrained global fixed income portfolios. My name is Luke Copley. I'm a product specialist for the Allianz core fixed income team. And in today's session, I'm focusing on our Allianz Global Opportunistic Bond strategy. In response to the latest Fed speak on the scope for a 0.5% increase in policy rates, compared to the usual 0.25% hiking increments that we've seen in the last 20 years, we have recently revised our targets for when to engage with long duration views again. The Fed's desire to act quickly and in larger steps could trigger rates to overshoot now, near term. So for now, we are being nimble with our target setting. We keep reassessing our fair value estimates, plus our assumptions on the terminal Fed funds rate for this cycle. Being close to neutral duration risk in portfolios, or marginally short of neutral as we are now, feels like a good place to be. And we can be patient, perhaps a little greedier on the yield levels we wish to see before implementing large directional duration views in portfolios. Much has been made recently of the prospects of stagflation and therefore a return to 1970s economics, although it's worth pointing out that today's job market, savings dynamics, today's dollar environment are all very different from back then. We're expecting an unusually short and non-conventional cycle, but not a protracted period of true stagflation. However, if energy prices and inflation do persist at high levels for the rest of the year, at some stage we should expect headwinds to growth, and the stag part of that stagflation equation will definitely come into sharper focus. It's this next potential cycle phase that could see safe haven bonds and duration rally strongly. So whilst our near-term outlook is for upward pressure on yields, a quite conducive backdrop for adding credit risk, we know that we need to be nimble in evolving our strategy to a longer duration, more defensive posture as the cycle turns. Now, our unconstrained strategies have the flexibility to position for both of those environments. And so this is the big dichotomy facing investors right now. The 3 to 6 month horizon could play out very differently to the 9 to 18 month type of horizon.